Welcome to the Highlights Show. I'm Phil Kessler.
And I'm Amy Ryan. It's great to be here.
Wow. Okay, that was a flood of information, wasn't it?
It really was. An hour just packed.
Yeah, just diving into futures day trading, specifically this whole prop firm ecosystem stuff.
Mm-hmm.
My head's still kind of spinning, running the numbers.
Mm-hmm.
It wasn't just like, here's a setup. It felt like a complete blueprint, treating trading like an actual repeatable business.
Absolutely. I mean, most folks, especially with futures, they treat it more like a really expensive hobby, right?
Totally.
But what we saw there, it just reframed the whole thing right from the start. They laid out this operational plan, all geared towards consistent payouts.
And using that mechanism of multiple funded accounts.
Exactly. They hammered that point home. This isn't about being some kind of market wizard. It's execution, pure execution.
And execution that works across different firms, too. They mentioned Phoenix Trader Funding, Apex, Top Step.
Right. So it's not locked into one specific set of rules. It's adaptable.
Yeah. But, okay, before we get into the scaling and the business side, the funded accounts.
Yeah.
We have to talk about the technical strategy. Some of that was really counterintuitive.
Oh, definitely.
Okay, let's unpack this.
Agreed. Let's start with that signature system they kept mentioning, the Heinz and the Mini Heinz.
Yes.
What really surprised me, honestly, was how laser-focused it was on just specific dollar levels, completely ignoring almost everything else you'd normally see on a chart.
That's what got me, too. My first thought was, hang on, why are we throwing out all these sophisticated charting tools? Why bet the farm on, say, 25,400 or 25,450? Just these clean numbers.
Well, what's fascinating here is that the whole strategy, its core, is purely about predictable price action right around those whole dollar and half dollar levels.
Predictable how?
It strips away all the subjective stuff, the interpretation. The idea is purely mechanical. These specific spots are where institutional liquidity, often the high-frequency trading algos, they tend to cluster.
Ah. Okay, so it's not just psychological levels for us retail guys. It's operational targets for the big players.
Precisely. Think about it. HFT algos, they often use these levels to sweep liquidity, maybe triggering stop losses just below a whole number or hitting limit orders just above it.
Right.
So by spotting these roll-throughs, the strategy isn't trying to predict where the market's going long term. It's just betting on that quick burst of momentum, that kinetic energy that happens when big money pushes the price through one of those clean levels.
Okay, so that's how you get a positive expectancy system out of it. You're trading a very specific, repeatable, momentary event, not just guessing if the NASDAQ is up or down for the day.
Exactly.
But, okay, let me push back a bit. Doesn't ignoring the bigger picture, the overall trend, introduce a huge risk if you're just playing these tiny micro moves?
That's a fair question, and they did touch on that, defining the trade duration very clearly. Because the whole point is to capture that immediate roll-through momentum, the trade itself is usually really quick. It relies on that fast acceleration right past the liquidity point.
So if it stalls?
If it stalls right after the roll-through, you're out. They stressed it. This isn't about riding a trend for hours. It's about exploiting a temporary high-probability imbalance in order flow right at a known critical price level.
Okay.
Think of it this way. Traditional TA often looks backward, right, at price history. This is looking forward just a few seconds, anticipating the order action at that specific point.
That explanation clicks. And it leads perfectly into the next thing that really jumped out at me, maybe even more radical.
Right.
Basically throwing out charts altogether.
Right. I mean, if your whole strategy hinges on order flow at those key dollar levels, then staring at historical candles, it becomes secondary, doesn't it?
It seems like it would have to.
Their whole insistence was prioritize the DOM, the depth of market, your level 2 data, and time in sales. Put that way ahead of traditional chart indicators.
So stop looking at the painting. Start watching the paint cans move in real time.
That's a good way to put it, yeah.
But for someone used to charts, I mean, that sounds incredibly difficult. Why is looking at raw level 2 data seen as better? And what's the mental hurdle there? Because it seems huge.
Well, it's considered superior, for this strategy at least, because it shows you where the market intends to move, like right now, where the actual buy and sell orders are stacking up.
Okay.
A chart indicator is always lagging, right? It's based on past price. And often it can be misleading because the big institutions have already acted on the information that creates the indicator pattern.
Right. Delayed signal.
Exactly. But the psychological hurdle, yeah, it's massive. Level 2, time and sales, It's just raw numbers flying by super fast. It demands a totally different kind of focus, more immediate reaction, less contemplative analysis.
Which must be why they simplified the entry trigger down to just those dollar roll-throughs.
Precisely. You use the DOM to confirm the aggression of the liquidity right at the moment of the roll-through, not to try and interpret the whole market structure from it. Keep it simple.
Gotcha. And they gave us another tool, a specific one, to kind of supplement that DOM read, which was new to me, that correlation idea.
Ah, yes, using the leveraged ETF.
SQQQ as a leading signal for moves in the MNQ, the micro NASDAQ.
Yes. What's fascinating here is...
Tell me why that works. Why would an inverse leveraged ETF predict moves in the futures contract? It seems backward.
So this is where you connect broader market sentiment with the immediate market structure. SQQQ tracks the inverse of the NASDAQ 100, right?
All right. So when the NASDAQ goes down, CQQ goes up.
Exactly. So when market sentiment shifts really fast towards fear or bearishness, you see volume spike hard in those inverse ETFs like SQQQ. Because it tracks that whole big basket of stocks, its movement often reflects those super fast sentiment shifts before the full momentum gets absorbed into the pricing of the smaller, more liquid futures contract, the MNQ.
Ah, okay. So it's like an early warning system.
Pretty much. A quick, high probability heads up. If you see strong momentum suddenly ripping in SQQQ, you should be ready for a related, probably opposite move coming very soon in the MNQ futures.
That's actually really clever, combining that broad sentiment read with the very specific order flow entry. Okay, let's connect that entry directly to the risk management piece, because that was another huge non-negotiable part of their system.
Oh, yeah. It's all about controlling the drawdown. That's the number one killer in any prop firm evaluation, right?
Okay.
Obviously. So they were incredibly strict on position sizing, specifically recommending just 1 to 5 micros, MNQ micros.
And why micros specifically?
Because it ensures that even if a trade goes immediately wrong, which, let's be real, it will happen, the dollar hit is tiny compared to the account size, especially the drawdown limit.
So it's not about hitting home runs.
Not at all. This is about hitting singles and doubles, accumulating hundreds of small, controlled, positive expectancy wins, base hits, like you said.
And the way they managed the trade, once you're in, it seemed aggressive, but also very calculated. You take that initial micro entry, and if the roll through works, if price moves your way,
you immediately start scaling into the winner. That was the protocol. Add micros as the momentum confirms itself.
What?
Then, importantly, take partial profits pretty quickly to lock in gains. Secure the bag, basically. And crucially, always keep one micro lot on as a runner.
Ah, the runner for those bigger moves.
Exactly. So you achieve those consistent daily profit targets you need, but you still give yourself a shot at capturing those occasional big runners without risking your initial capital significantly.
And the main principle behind all that was?
Focus on managing the P&L of the current trade. Forget your predictions, forget your hopes, forget your fear. Just trade the P&L you see right now.
Manage the trade, not your emotions. Which brings us to the bigger picture, the mindset. This whole execution system, it really only works if it's plugged into a proper business plan, doesn't it?
Absolutely. And they kept warning about the psychological side, how hard trading alone is, and why you have to trade without emotion.
So how does the routine help with that?
Well, the consistency comes from that strip routine. It's designed specifically to fight against emotional trading. That recommendation to heavily favor the market open, the early session.
And be done by 11:00.
Yes. That's brilliant psychologically. It forces you to avoid the choppy, low-volume midday mess where traders just sit there, get bored, and inevitably force bad trades. Low probability stuff.
Oh, man, how many times have we all done that? Stuck in that midday drift, making some stupid revenge trade. That 11 a.m. rule feels like a necessary intervention.
It's a deliberate cutoff. If we connect this to the bigger picture, by limiting your screen time to the highest probability, highest volatility hours, usually the open, you maximize your potential return for the time you do spend, and you drastically cut down the chances for emotional screw-ups. It's trading based on market structure, not just sitting there hoping.
Trading based on structure, not endurance.
Yeah.
I like that. And they were super clear that this emotionless approach requires deciding beforehand what you'll do in every situation.
Every single one. They literally said every trade has only 3 outcomes. Goes your way, goes against you, or does nothing, goes sideways.
Right.
And you must have a rigid, predefined plan for your entry size, your stop loss, your profit targets for each of those scenarios, before you even click the button.
Takes the hesitation out, because hesitation kills you in trading.
Kills execution. Exactly. When the moment comes to act, the decision's already made. It's just following the plan.
And the way this all ties into the prop firm model, that seemed like the real commercial genius of the whole framework, getting that consistency and then scaling it up.
That's the path they laid out. Using the evaluation structure, these firms offer to build multiple funded accounts, PAs they call them, profit accounts, I guess.
Yeah, PAs.
And that is the ultimate risk management play, isn't it? You completely separate the risk needed to get the capital, which is just the small evil fee, from the risk you take when trading the actual funded account.
So instead of sweating over one massive account,
you're running maybe 3, 4, 5 smaller accounts. And they showed examples, right? Hitting consistent daily gains, maybe $200 to $700 a day spread across these accounts, using that same low-risk, high-frequency micro-lot strategy.
So scaling the payouts from multiple accounts rather than trying to trade one giant account really lowers the mental pressure on any single day.
Totally. It's like a portfolio approach, but for managing your trading capital sources. Makes perfect sense.
This whole thing was genuinely eye-opening, like a real education in trading as an actual business structure. If I had to boil it down, the 3 things that really challenged my assumptions were, first, the mechanics of that Heinz system, just focusing on whole and half-dollar roll-throughs, playing the HFT liquidity games. Second, ditching the charts almost entirely in favor of reading the DOM and level 2 live.
Right. And third, that whole business plan of using multiple prop firm accounts to scale up payouts while keeping your personal risk separate and small.
And I'd add, for anyone watching this or thinking about it, the clarity of the actual roadmap they offered was huge. It wasn't just random tips. It was a very specific structure. Learn the system, practice it on sim, pass the evaluation, then scale up those PAs, those funded accounts, into a steady income stream.
Yeah.
That structure itself provides the discipline that, let's face it, most solo traders just don't have on their own.
The level of detail on both the trading mechanics and the business side was really impressive. Honestly, if you're out there listening and you're curious about how to maybe shift your day trading from feeling like an emotional roller coaster, a gamble, into something more like a repeatable, risk-controlled business, that full session they did is absolutely worth watching start to finish.
It really lays out a detailed framework you can potentially follow or adapt. It's substantial.
For sure. So for you, the listener, maybe here's a final thought to chew on, building on what we just discussed. What would actually changing your trading hours, focusing only on those high probability morning sessions, being really strict about being done and shutting it down by 11:00 a.m., what would that one change do for your overall consistency and maybe more importantly for your mental capital? That deliberate restriction, it might be the single biggest lever you could pull. Definitely something to think about.